Good afternoon, everyone. It is a pleasure to be back in India talking to people I miss constantly in London. I'm going to try and keep all that emotional stuff later for the ending of the talk. I had the opportunity to come and do some business travel in India for the first time in my role. And I thought it would be a wonderful opportunity to come and talk to the good friends at XKDR. In my day job, I work as an economist for a company that does research for macro hedge funds. And I basically get to deal with all the issues I'm going to talk about on a day-to-day basis. The idea of this talk was just to give everybody a sense of how the rest of the world is doing and how it thinks about India. So it's ambitiously titled Trade Wars, De-Dollarisation and Decoupling, macro themes for the roaring 2020s. It is one part kind of an explanation or potential explanation for why we are in this kind of phase and why the US administration has followed this set of self-sabotage policies to kind of move along the global world order in a different direction. Then we're going to kind of discuss very briefly what are some of the research themes which might be important in the coming 5 years. And I have one final slide on India because I'm here to learn from you all rather than give you my ivory tower view from London, which may not be accurate. All right. So starting with some philosophy before we get and some history before we get into the meat of the matter. There are some scary similarities between the 1920s and this decade of the 2020s, right? And just to run through some of the themes which were similar in these two decades, 1920s, the First World War just got over, you had the Spanish flu, and there was a huge post-pandemic boom led by a new technology. At that time, it was industrial production. Today, it's AI. At the same time, you had very similar rise of protectionism in the US, where they were like, we have this industrial base, it's untouched. We need to make sure it is the best in the world. And the precursor to the Smoot-Hawley Act was the Forney-McCumber Act of 1924. And you can see some parallels between that turn towards protectionism and what is happening today. You also had pressure on existing monetary arrangements. Britain famously left the gold standard and came back to the gold standard during that decade, which was a large source of movement in exchange rate arrangements during that time. Because if you remember, the pound was the dominant currency at that time, and everybody was kind of pegged to the pound. And the question was, what comes next? It's fairly similar to the questions we're asking in this decade about what comes after the dollar. Now we get to the great Gatsby bit of the talk, where there are two sort of competing things that are happening. You have this huge K-shaped recovery with increased inequalities after the pandemic, where it's the best of times for a certain strata of society, and it's the worst of times for people who feel they're left behind. At the same time, and there's a rise in authoritarianism, led in part by sort of post-crisis inflation. And we really can't ignore the role inflation has played in sort of the rightward turn globally. Targeted misinformation, at that time, it was radio and print. Today, things have evolved much further. And cults of personality. 1925 was when Mussolini marched into Rome. And 2025, somebody else marched into the White House, which was...
Shekhar, say hello to our old friend Tarun Bajaj.
I thought... All right, so this is kind of the outline. There is a very good illustration of what the world is kind of going through. This is a chart from the external balance report of the IMF, where they're basically tracking FT coverage of themes relating to the international monetary system. Unfortunately, this graph only extends up till April 2025. You can imagine right now, we're somewhere close to GFC and Nixon shock levels in terms of interest in the topic of what happens next with the global monetary system. And this long history comparison is kind of important because, we're dealing with a pretty complex and challenging environment. At the same time, I want to provide some optimism that we've been here before as a species. And, unfortunately, the interwar period ended with World War II. I think it is incumbent on us to kind of avoid that tail outcome as much as possible in the 2020s. That being said, the talk is fairly standard. It's stuff you've already heard from other people who are sitting in this room. I'm going to first talk about the trade war and de-dollarization, and I'm going to go through why the US kind of chose these sets of policies. What are the aspects of these policies? Will they persist? And what is the state of dollar dominance and de-dollarization as we speak? So this would be data up till Q2 of this year. Then we're going to kind of discuss how the trade war is creating a divergence between US and G20 policies. The last two sections are weak because I ran out of energy. We're going to kind of discuss very briefly some macro themes that come out of this current environment. I'm going to end very quickly, maybe hide that slide entirely with some thoughts about India. All right. So this is the slide. This is a chart everybody has seen. This is maintained by the Yale Budget Lab, which kind of shows you that US tariffs in 2025 jumped to the highest level since the late 30s. So, we're at sort of protectionism from the world's biggest economy at a level we haven't seen for a very long time. Now, how did we get here? And what the hell is the Trump administration thinking when they are introducing these kind of policies? Borrowing some language from the IMF, the Trump administration thinks they're conducting a structural adjustment program for the US to deal with a problem of twin deficits. So there's a feeling amongst the Trump administration that the US should no longer be the global consumer of last resort and absorb all the global imbalances themselves. This has also kind of been turbocharged by the fact that there was a large increase in the twin deficits, both the current account and the fiscal deficit during the pandemic. Now, a couple of interesting quotes to kind of set the stage. Michael Pettis, pretty influential economist during this phase, he's made this argument, and this is something a lot of Trump insiders really believe, that American trade deficits force Americans to choose between either higher employment, unemployment, higher debt, or greater fiscal deficits. It's a bad deal for America. And the next is a very funny quote by President Trump, where when he justified tariffs, he said, maybe children should have $2 instead of 30 this Christmas, which is a soft way of saying that maybe we shouldn't consume as much anymore. We should be a little more austere. Take it as you may. Now, President Trump and his inner circle have always thought of tariffs as an effective policy to deal with twin deficits since Trump won. And there is some path dependence to this story, which we saw during the Biden administration as well. So it is fairly bipartisan now. You can say that there are very few classical trade liberals left in the US. Now, this also kind of fits in with the standard sort of things which US policymakers have been talking about for the last 15 years or so, which is that China doesn't adhere to the rules of the game. There needs to be some sort of US industrial policy or US policies to deal with the China challenge. If I think about the trade war or the way it was envisaged by policymakers in the Trump administration, it's basically China at the core, with everybody else kind of caught in the crossfire. And I'm going to try and make this case a little more strongly. All right, so this is just a quick chart of US twin deficits. I'm sorry, the legends are a little small. The purple line is budget deficits, and the blue line is the current account deficit. You can see that the current account deficit annualized is running anywhere between 4 to about 5.5% of GDP. And the fiscal deficit doesn't look that bad this quarter, but it should end up at around the 6% mark. So twin deficits around 10% GDP. It's fairly large.
Wait, when you say twin deficits, it's 10%.
Uh,
It's 6%.
so it's, if you so the federal budget is year to date on a fiscal year basis. So it's only up till June. So it'll most likely end up doubling to 6 by the end of the year.
Fine, that's it.
Yes.
Why do you say then?
Because of 4% current account deficit.
I'm not getting it. Here's my understanding of the macroeconomic identity that the fiscal deficit contributes to a reduction of domestic savings.
Right.
And the savings investment gap is the current account deficit.
Yes.
You can't add the two. You can't add the fiscal deficit and the current account deficit.
This is just a bastardization of the concept. I'm not saying that this is the external financing need. This is the overall financing need.
But one is paying for the other. Conceptually,
Yes.
the current account deficit funds the fiscal deficit.
Yes.
So I think addition is not correct.
Agreed. Just one of the dirty market tricks we use to scare investors. This is a chart which has basically kind of got US policymakers unhappy. The red bars are US deficits, and the slightly, I want to say, light orange bars are China. And the US administration is not very happy that the US is absorbing most of the world's current account surpluses. Now, usually when a country runs its fiscal policy hot with a high fiscal deficit and sort of a current account deficit, usually you expect that currency to depreciate. And when the US kind of blew out these deficits, something very strange happened, which is that the US dollar actually hit all-time highs between 2022 and 2023. So here you're seeing sort of the nominal broad trade-weighted dollar index. And as the Trump administration came into power, there was also a feeling that the dollar is way too strong given the kind of deficits we're running. Now, there are some reasons to why this is the case. We're going to explore it in a little more detail going forward. All right, so two things which kind of explain dollar dominance over this period is the fact that the US came out of the pandemic looking slightly better than the rest of the world, given the size of the fiscal outlay and the monetary fiscal coordination which happened during the pandemic. And there was a phase of US exceptionalism with sort of the equity inflow story into the US. Now, even before the pandemic, we know that the dollar is fairly dominant in global trade and financial markets. So on your left panel, you have sort of GDP shares of the major reserve currencies. And on the right side, you kind of have what is the share of the utilization of these currencies across different aspects of internationalization. And you can basically see it is sort of a dominant one and number two, everybody else. To use a football analogy, it's Bayern Munich and everybody else in German football. Now, this is a chart which kind of shows you that the rest of the world has kind of recycled most of its surpluses into US dollar assets. Now, this doesn't really reflect all the allocation the world has done into USD assets because it's based out of IMF data. But essentially, US is about 20% of global GDP. But if you kind of use publicly available data sources, it's somewhere between 30 to 40% of global debt portfolios. And equities, there are some sort of measurement issues given tax havens, etc., you can roughly say between 35 to 50% of global assets are in US equities. Now, in terms of the magnitude of sort of the size of US uh, asset supply, dollar assets kind of dominate global safe asset supply. So this is a chart which took a long time to create, which is the change in central government debt free float minus net issuance of debt securities, which is kind of accounting for maturities, less local central bank purchases and foreign reserve manager demand. So you're controlling for essentially all the fixed, sticky, preferred habitat investors, central banks and other central banks. And you're also controlling for the fact that some amount of your debt has to be rolled over. So this is kind of like fresh issuance. And this is in trillions. The rest of the reserve currencies or the traditional reserve currencies, they pale in comparison to the amount of US debt that has been issued since the pandemic. In terms of the global financial system, if you want a safe asset, if you want to express a view, more or less you express it through US treasuries. And it's because the US runs really large deficits. Now, something has changed quite dramatically since the GFC. Now, the standard global imbalances story, which Bernanke spoke about in 2005, which got popular before the crisis, was that it was this official sector reserve accumulation, which is responsible for the US convenience yield and a lower net financing cost of US capital. However, since the global financial crisis, it has completely changed. You can see that official reserve accumulation has kind of gotten stuck and the private sector has kind of picked up the slack. So it's not essentially Bank of Korea, which is buying reserves, but it is the pension fund of Korea, the national pension system, which is buying US assets, recycling Korean surpluses. It isn't, and you can't call it a private actor per se, but that's how it's accounted for. So modes of reserve accumulation have changed. There's also a slight change in the financial architecture. Uh, Earlier, banks were sort of the leading buyers of global debt. Since the crisis, it has switched to more non-banks holding US treasuries. So this kind of tells you that most of US debt holding and sort of de-dollarization has to be done by sort of non-official actors. And this is a pretty big change. And non-official actors are driven by incentives, even though you can hit them with a stick every now and then and coerce them into doing stuff, they will kind of view it as a different process compared to, say, a central bank. All right. This is perhaps the most striking chart in the DAB pack. What this chart is showing is...
Shekhar, quick question. Do you have a sense of why the global private sector started holding US debt post GFC? Because this is where like zero interest rate. So the yields on the US bonds are not necessarily attractive.
It's because the rise of hedge funds doing the basis trade. And essentially, instead of banks and primary dealers warehousing US debt, you have these non-banks who are holding it, and then they're rehypothecating that collateral. That's sort of the story, but we can get into more detail of this.
Yeah.
Right, so best chart in the deck. What is it? What does it show? This shows cumulative foreign flows into US equities versus flows into Europe, Japan, and EM equities. This data is coming from EPFR, and we're only looking at cross-border flows. So here, what the blue line is capturing is essentially an Indian mutual fund buying US equities and vice versa, a US mutual fund buying Indian equities. Two things jump out immediately that in sort of the 2000 to 2020 period, it was like a massive era of shifting equity flows around to the rest of the world. Something dramatically changed during the pandemic. And, there's been such a gigantic reallocation of capital, especially on the equity side, to the US. Now, this is keep that equity point in mind. It's going to be relevant when we get to sort of de-dollarization. Now, as we started with, the dollar is too strong for the liking of the Trump administration. Even though their policies are pretty muddled, they would like a weaker dollar, in my opinion. And Trump, true, is leaning into the idea that tariffs can be used as a tool to reduce bilateral trade deficits and bootstrap manufacture the US. Whether it's correct or not, it remains to be seen. Now, their whole idea is you solve this problem of global imbalances via a mix of tariffs and currency policies. And this gentleman whose smiling photo I've put on the slide is Stephen Moran. He's probably going to be a Fed board governor, taking the place of Kugler. He's in the Senate confirmation process. And he wrote a pretty, I guess, influential work about a Mar-a-Lago Accord in lines with the Plaza Accord in the 80s. What is the Mar-a-Lago Accord and how does this fit in with the Trump idea of making the US dollar a little less strong? Well, you can think of it as an intentional or unintentional way to make the US a less attractive portfolio investment destination. It's aggressive tariff policy, which reduces not just their growth, but global productivity as well. The note talks about potential capital controls in a US context, which could be some kind of market access charge to use the US dollar, changes in tax treatments for US investors, stuff like if you are sort of a Canadian pension fund, you don't really pay taxes on the interest income you earn on US treasuries. And the US wants to make it taxable, take sort of the world's premier safe asset and make it a little less attractive to hold. They also have crazy ideas of canceling swap lines, about making sure all foreign official investors hold very long-term debt rather than short-term debt. Now, small tangent here. When we kind of think about official sector holding of US assets, on average, the maturity of a bond held by a central bank is between 2 to 5 years. They keep most of their intervention portfolio in foreign bills, and the duration they house is this middle of the curve. Everybody else is the private sector which is holding sort of duration as you think. And this is an idea to force the official sector to hold very long duration assets, which would make it very unattractive to do any kind of intervention. We're going to get to undermining of US institutions and rule of law soon enough. All right. So I think the Mar-a-Lago Accord is an interesting set of ideas, but it is mostly the Trump administration's displeasure with a dollar that is too weak, which is too strong compared to these fundamentals they care about so much. The trade deficit and its sort of co-integrated cousin, the fiscal deficit.
But Accord doesn't talk about the potential effect all of these can have on the declining role of the dollar in international trade and financial transactions, right? So that's the silent part that the Accord doesn't touch. Even though Trump seems to be quite angry about countries moving away from the dollar. So that dissonance is
Absolutely. And I guess it speaks to the fact that you still need some sticky official sector demand to fill that external financing gap. Uh, it's just that private sector is kind of constrained to take more of this fixed income supply down, given that rates have been high and they're sitting on a bunch of unrealized losses. And the reality of private sector institutions, especially regulated private sector institutions, increasing their allocation to interest rate risk and duration risk, it's a tricky thing to move in a short period of time.
Sure.
Yeah.
One further question. Can you elaborate on the remove USD safety that campus for lights? How is this work actually in action?
So take, for example, somebody like Bank of Korea. They're a US ally. And if there was sort of a global dollar funding shock where dollar liquidity ran out, then the Fed has a bunch of tools in addition to swap lines to ensure there is some kind of utilization of the Fed's lender of last resort function to enable dollar liquidity in offshore centers.
That is, is that or even private investors, for example, like hedge fund sitting and they can actually get this, or is it only reserved for the?
So I'm Divya saying you should speak louder about the question.
I see. So my first question was, what is the meaning of the USD safety net and canceling of the swap lines? What is Shekhar has answered? And the second question, the follow-up question is it true? Does it equally hold true for hedge funds sitting in, say, out of Malaysia, Mauritius, as it stands for a bank, central bank out of Korea?
I think this is mostly directed towards the official sector. And you can see there is very little mention of the private sector here. The anger is against other official sector actors.
I would have thought that if you reduce USD safety nets, you reduce the glory of the USD as a safe asset for private persons worldwide also. So private persons would rather do more euro, or as he's been saying, CHF and gold and, nutty things.
Yes.
Because the glory of the USD today is the safe, trusted, good institutions. They will solve practical plumbing problems after the GFC.
I think that's an indirect implication. If you jeopardize liquidity support for Korea, then it's less attractive for the pension fund to recycle those surpluses into American assets. So it is a surgical strike, so to speak, on the plumbing they designed after the crisis. All right. Given that we can't really disentangle fiscal and current account deficit issues, these unorthodox ideas extend to this realm as well. Even though Republicans are considered conservative fiscally, the budget bill has widened their fiscal deficit, and they're going to be running at anywhere between 6 to 7% of GDP for the foreseeable future. Their solution here is that tariff policy will also raise some revenue, and at the same time, you can renegotiate some terms of US security umbrella, as in blackmail countries, and force your own central bank to lower interest rates to reduce your fiscal burden. Now, how do they do this? They market tariffs, which is a tax hike on US consumers, as a tax on the rest of the world. There is a reverse Marshall Plan in motion, which ties into this, which is to force the rest of the world to increase FDI investments in the US in strategic sectors. And at the same time, there's a security blackmail as well, where the US administration feels they're spending too much of their money on defense, so the rest of the world should pick up the slack so that they can reduce their own defense spending. The Pentagon reducing its own defense spending is the funniest thing I've heard in my life. And obviously, we're going to get to how they're trying to coerce the FOMC to keep interest rates low. Now, as you can tell, there are strong internal contradictions between the stated policy goals and textbook outcomes. All right, let's take the example of just this reverse Marshall Plan and what it means on a BOP basis, right? So you want Korea to stop buying US equity assets, but instead do direct investment into the US. You have just changed the mode of recycling that surplus from a portfolio investment head to the FDI head. And there could be a reduction in the current account balance, in the trade deficit the US runs with Korea as a consequence. If Hyundai makes more of its cars in the US instead of exporting them from Korea. But there's another entity in the balance of payments called the primary income balance, where income payments from the US offset whatever dent you managed to put in the trade deficit. So it's a zero. It doesn't move the needle on the current account balance or the current account deficit problem the US is trying to solve. At the same time, if you are tariffing the rest of the world, it is very unattractive for somebody to come and do FDI in your country. 50% steel tariffs, tariffs on more metals incoming, semiconductor tariffs. You're going after the rails of manufacturing in a way which makes it super unattractive.
Can I ask you one thing? So let's say hypothetically speaking, Korea invests massive amount in US and starts manufacturing and exporting from there. And the trade deficit of US and Korea goes down. Right? That is an outcome that
yes,
which would achieve what they are trying to do.
Yes.
So FDI will go up, yes, but exports will go up as well.
That's why I'm taking a current account balance view rather than just a.
What's the personal income? I mean, how does it offset this increase in exports so much?
So the best example to see this is Japan. Japan runs a goods deficit with the rest of the world. They haven't run a goods surplus since the start of the pandemic, but they have a massive primary income surplus because they own so many assets and there's so much retained earnings which is being repatriated back, at least on paper, to balance the books. So you're just changing something which is kind of like a trade invoice into sort of a, I guess, income flow between the same group company. So it'd be Hyundai US sending money to the Hyundai parent rather than Hyundai Korea booking those exports.
Numbers are much.
Yeah, exactly.
So on a 100 rupee car, the retained earnings will be 7.
See, they cannot offset. So what is it? It's zero. I'm not sure that that's.
It's not going to be a complete offset. And this is sort of a long run process.
Actually, the trade deficit goes down significantly.
And like, I also see the fault in my reasoning in as much as if you're being forced to do FDI, you don't have much retained earnings to repatriate because you're kind of holding it there to basically reinvest those earnings. But in the long run, when we're all dead, it doesn't have much of an impact is all I wanted to highlight. And here you're basically turning something which is a clean export flow into sort of an accountant's dream. FDI flows and stuff which is hard to account for and hard to track what global imbalances actually look like. All right. The final thing I will say here before segueing to my next section is that their motto is move fast and break things till you are stopped by courts or more assertive foreign powers. Right now, we're going to focus on the stopped by courts. Now, there are two really important cases which are present in US appeals courts. The first one is about the legality of tariffs. Most of the tariffs announced by the Trump administration, which are not under sections 3.
Please press your point right before you quote the legal part of it. So in the Mar-a-Lago report and all subsequent discussions, there's concern about the twin deficit, there's concern about dollar strength, etc. But again, there is no concern about potential inflation.
Yes.
So that doesn't appear anywhere.
If you
The fiscal deficit plus tariff, it's all inflation.
Yes.
But that's not something that they're concerned about.
Yes, that's right. Because if you buy $2 instead of 30, where is the inflation?
They have cake instead.
All right. So this is another section I've stolen from some much better lawyer friends. So please bear with me. Most of the tariffs which have been sort of instituted by the Trump administration since February 5th are under something called IEPA, the International Economic and Emergency Powers Act, which gives the President of the United States the power to designate an economic emergency and use whatever tools there are at the office's disposal to solve that. Now, and the reciprocal tariffs and the fentanyl tariffs and the India punitive tariffs, they all fall under this bucket, right? Now, clearly, there are US importers who are not very happy with the imposition of this tariffs. And they filed a set of lawsuits against the US government. The Court of International Trade, which is the first court which looks at this matter, deemed it illegal sometime in May. And the appeals court saw this matter about a week and a half ago, where they kind of towed the line between the Court of International Trade, punting it towards the Supreme Court. So what they basically said is that these tariffs aren't completely illegal, but presidential power isn't unbounded. So at some point, if you kind of put these tariffs in place, you have to justify them on what is the economic emergency, what you're trying to achieve, and put it to congressional review. Now, this is most likely going to head to the Supreme Court in October, which will be sort of a landmark decision in terms of use of presidential powers to regulate trade. Now, the Supreme Court's going to try and strike a balance between the president's power of declaring a national emergency, which they feel is a fundamental part of the office of the presidency, and the role of Congress in challenging that national emergency. And these big words, reasonableness, effectiveness, they're going to be really sort of well litigated. Now, there is a fair deal of debate on what the Supreme Court review will end throwing up, given we have a very Republican-leaning bench sitting. It's, I think, 6-3. There is some consensus amongst law firms that fentanyl tariffs on Canada, China, and Mexico will most likely be struck down, given the lack of connection between the drug trade and the current account deficit, which is the stated economic emergency. Reciprocal tariffs, which is more relevant for the rest of the world, is a toss-up. My personal lean is that they will be deemed illegal as well, but it is harder to predict. Now, what could the US Supreme Court do? They could order the administration to sunset clause the tariffs, say that they can only be applied for a particular amount of days, after which you have to subject it to more rigorous constitutional approval. And this also gives the US administration some time to use their other sections to kind of reintroduce those tariffs in some other legal authority. So they're basically going to say, this isn't an unlimited thing. Please use some other means at your disposal. However, the larger legal question is regarding the limits of presidential power in declaring an emergency. This is the Caesarean question. Uh, there is no clear answer to this. I'm at some level, I'm hoping that they deem it illegal, given sort of US's legacy of having very nice congressional review of all their policies. But it's a toss-up. My
Question, maybe right one, but since we started with the 1920s parallel, back then when massive tariffs were imposed, and the entire move was towards protectionism, was there any kind of legal obstacle then, or it was just like a steamrolling of the processes?
I will have to get back to you on this one. Yeah, smooth Holly, but that was in the 30s, actually.
Precursor of smooth Holly.
I think that was a little more well accepted by US industry because it was more mercantilist times. They wanted to protect their car manufacturing industry from, say, imported cars, etc.
There's no question of declaring an economic emergency.
No, it was an act of Congress as well. The Ford name.
And all that.
Let him finish.
Yeah.
All right. Yeah, I guess I'm running out of time. All right. The only bullet on the slide which is relevant, my best guess for India is that the 25% reciprocal tariff is deemed illegal under sort of bullet number 2, but the 25% punitive tariff rate for Russian oil imports stands. This is with all the caveats that we don't know what exactly is happening in the US-India trade relationship situation. But that's my best guess, because if you kind of look at the Russia oil imports punitive tariffs, it actually fits the definition of an economic emergency based tariff. That being said, we have so many more tariffs to look forward to, and it is conveniently ignored when the market is rallying and everybody is eating tacos on Tuesday. We have pharma sector 232s, semiconductor 232s, furniture 232s, shipbuilding 301s, and negotiations with China and Europe, which are ongoing. China is on a 90-day deadline, which will lapse sometime in late October, November. And we really have no idea whether they're going to ramp up the pressure on China in the next set of tariffs or not. But the market is kind of putting its head in the sand and saying that we'll deal with it when something happens. So whether or not IEPA tariffs are struck down, there are a lot more tariffs under less justiciable sections of US law, which are going to come over the next, I guess, how many months are left for his presidency? Lots. 40 odd months. All right. The second case, this I'm going to run through very quickly. The Trump administration is also trying to control the Fed board. We've all seen the spat between Donald Trump and Jerome Powell. They're also going after individual board members because the FOMC, as it's structured, the chair does not have much power. It's just a person who is guiding the votes rather than, forcing people to vote a certain way. So you really need to get some kind of quorum amongst the voting members to actually move policy. Now, Dr. Lisa Cook was a member appointed by the Biden administration who has been accused of committing mortgage fraud. Even though it's sort of a small technical matter, and less than 50 people every year are convicted in the US for mortgage fraud every year, there is some evidence to suggest that she misrepresented some facts on a mortgage application. It was discovered by some Trump supporters. This information was leaked to the public, and he fired her on social media. Now, the US administration is going to argue that there's sufficient evidence that you are not a fit and proper person, and we have enough cause to remove you for this sort of indiscretion, however small it may be, you have broken the law and you're not fit to do this. Dr. Cook is going to challenge this by saying that for cause language needs to mean something. I have been through sort of congressional review and Senate approval, and you haven't followed any due process in terminating my job. In this case, I think lower courts are most likely going to rule in Dr. Cook's favor, as lower courts should. And there is some case law which suggests that the Supreme Court has also acknowledged the Fed as a semi-private institution. And presidential powers only get relevant when a quasi-public person wields considerable executive power. You can argue that a single governor at the Fed board doesn't have much executive power because it is a board. That is the beauty of that particular structure. And you need to kind of keep the Fed independent. Once again, no idea what the Supreme Court is going to do, but lower courts are definitely going to support.
Go back to the previous slide. What is the DOJ initial criminal investigation against what?
For mortgage. Yes, for mortgage fraud. Yes.
This is also new. Meaning two separate things. One, this level of politicization of law enforcement. And second, sacking. The two distinct monsters in it.
Yeah.
This is something new.
This is like Pakistan.
So the FOMC has 12 members. Yes. She's just trying to get rid of one and replace that person with somebody.
So I think there are only before Adriana Kugler resigned, there were only 2 vacancies on the Fed board that needed to be filled, which was Kugler herself and then Chair Powell in, I think, 2026 at some point. 2028. I'm mistaken there. What happens in the Supreme Court is probably going to be dependent on the legal facts, whether the criminal investigation finds something or not. It's a loaded deck, but it's going to have really large consequences for how people perceive the stability of US institutions. Trump really seeks an imperial presidency, and to kind of squish and stretch the concept of separation of powers as much as possible. A lot of US-China hawks, they are very supportive of this imperial direction because they think that's the only way to take on these centralized authoritarian states, which have longer sort of policymaking cycles and stability in how they build their economy. And in part because he's a crazy cult of personality person. If Supreme Court takes an expansive view that for cause, excluding policy disagreements, is something you can fire somebody on without being criminally charged, it's going to have a really big impact on how people perceive US debt, on how people perceive the Fed's credibility, and how people kind of think about this going forward. As Ajay mentioned, it is the classic fall in line or we'll make your life hell kind of policy making they're espousing. Bahubali behavior. All right. So I'm going to stop here for questions and to take a little bit of water, but we can jump into de-dollarization.
Being a businessman that he is, how does he not care about the stock market?
He does absolutely care about the stock market, but with US equities close to all-time highs again, except for those few panic weeks in April, there wasn't very much of market check and balance on his thinking.
The market has not been doing very well in the US. Every other day there is a decline.
I agree it's internally inconsistent, but according to the administration, it is doing as well as it has ever done. We are in a golden age.
Divya has a question.
Yeah, hi. Lovely presentation. Thank you. And my question is more about the design of the WTO as an organization. So, and also as a medium of where the countries negotiate the trade deals. And now that's been completely bypassed because basically America decided it has to be one-on-one with country-to-country basis. But from the WTO's structural design perspective, isn't that kind of bypassing the very spirit with which the organization might have been, set up for? And is there any clause in the WTO where you're not sitting on the table in a conference room of countries, but you're picking every country separately and you're having a tight table negotiation? So how is that organization by design trying to simmer down the temperature of country to country aggressions?
I think sort of UNO, WTO kind of organizations, stuff which was built on the foundation of sort of multilateralism and sort of group arrangements rather than bilateral ones, they're sort of dead in the water given that uh, all of these obligations come from treaties, and the current US administration doesn't really care about treaties. A good example of it is them going after the USMCA, which is the trade agreement between Mexico and Canada, their two largest trading partners, which is clearly an existentialist threat to a lot of workers in North America. uh, they don't really care. They feel that they have the power to force people into getting into bilateral sort of negotiations and extracting as much as they can from them rather than negotiating with multilateral groups. I know this is not a very satisfactory answer to your question, but I will try and get back to this towards the end of my talk, if that's all right, Divya.
Sure. Thank you. I think it sets the tone, but yeah, thanks. I was more curious about how they designed and the uh, evolution of the WTO and final trade at the collective. Yeah.
All right. Now we're going to jump into what the current state of de-dollarization is. And one of our best pieces of evidence is this survey, which is run by the Organization of Monetary and Financial Institution Forum, OMFIF. And they do a survey every year where they ask sovereign wealth funds and central bank reserve managers what you think about different reserve currencies. And surprise, surprise, they did their survey in June. Most surveyed central banks want to increase their share of non-USD reserves, with Euro and RMB as their top choices in the short run. However, a majority of central banks want to keep their dollar allocation constant. Lesser want to increase the USD share, and more central banks want to diversify away from the dollar. So it isn't as prevalent as you think, and it is the usual suspects who are subject to sanctions risk or tariff risk who are really leading this thought process of diversifying away from the dollar. Now, there are very strong market issues which make a choice like the euro or the RMB very less attractive compared to the dollar. As we've noted before, dollar is more liquid, it's higher yielding, and it is less segmented than all of its competitors. When you think about euro assets, a German Bund and a French OAT, they may be classified as investment grade core European debt. But to a reserve manager, there is only one safe asset there, even though both assets are supposedly similar. Same thing for the RMB, where it still has capital controls. Do you put your money in CNH? Do you put your money in CNY? What kind of liquidity support are you going to get? There is no alternative. However, you can think of a slow grind where the US reserve share moves from current 58, 59% to about 50%, euro moving to the mid 20s, And if China plays its cards right, the RMB hitting about 10%. This is just like a quick.
And that is just the official reserves held by central banks.
Yes, this is
Nothing to do with the private sector.
nothing to do with the private sector. So this is just a quick illustration of what has happened. And who are the central banks? They don't really reveal it, but these are some numbers to kind of put that in perspective. You can see that in general, even a currency like Canadian dollar has seen an increase in demand. Where are the Indians? All right. The second thing which drives me mad is that most of the diversification is not happening into other fiat currencies. It's happening towards gold. And gold shares in sort of allocated reserves are going up. Now, there is some evidence to suggest that there are only few central banks who are meaningfully increasing their gold allocation. Poland, Kazakhstan, Turkey, China, Russia, your usual suspects. Everybody else is kind of marginally increasing their purchases of gold. But this has been the most money-making trade over the last 3 years. And it's tough to beat gold. This is a chart which I stole from Goldman Sachs, which essentially shows that if you kind of look at monthly average of gold purchases pre-freezing of Russian reserves and post, it's roughly a 4x increase in the monthly central bank gold purchase. So something is happening. It's led by some large granular actors, but it's big enough now to crowd in other people into considering this reallocation. Are we going back to the gold standard? All right. So that's the official sector. For the private sector, I will mention two things. The first is sort of a country risk shock, which is very common in sort of the EM literature, which is that your exchange rate gets delinked from the interest rate differential. And in the US case, it's even more special. It's a reduction in the convenience yield. So there is some evidence that the private sector has started putting little more country weights on holding US assets. The second thing, which is a little more interesting and potentially something we should think about as well, is sort of what exactly happened during this period in April and May, where the dollar disconnected from interest rate differentials. What we are finding more and more in the data is that investors didn't actually sell their US assets. What they did is they started hedging their US exposure. If you recollect that equity chart, you can see the US received massive equity inflows in the pandemic period. Equity investors tend to be mostly unhedged. And when Trump announced tariffs, there was this massive panic, mostly by Asian financial centers, to hedge their dollar exposures. So what we've really witnessed up till now is a few actors hedging the dollar exposure, not reallocating out of the dollar. So, the dollar is alive and well as number one, and some risk has been reduced. This is a cute chart to kind of illustrate this. On the x-axis, you have net foreign assets in US dollar currency as a share of your GDP. And it's borrowed from Benetrix et al. And Allen et al. At the IMF, who basically kind of net out a country's net dollar exposure. What this chart shows you is that countries which had higher sort of net US assets appreciated more, which is soft evidence to suggest that financial institution hedging behavior played a large role in the dollar turmoil of April and May. Now, we can get back to this chart in a bit. All I want to say is that private sector is really biding its time in de-dollarizing. there are no visible signs of a change in dollar asset allocation as yet. And the prospect of higher US rates due to tariff-led inflation, which will happen down the pipe, makes US cash, which is the extreme short end, bills very attractive to global investors. Think of a Japanese pension fund. If they want to sit in cash, they're getting 50 bips in Japan, but they can get 4.5 sitting in a US money market fund. If the US is running hot, it just makes it a very attractive liquid asset for large real money investors to hold. Changing dollar asset allocation is likely going to be a multi-decade process unless we have 10 more tariff announcements tomorrow, and that for a long, long time.
Shekhar, on the hedging, the dollar hedging is very expensive because of the high short-term interest rates. Right? So the investors, they're not caring about the high hedging cost since 2022. That's essentially what you're doing.
And even when hedging costs have come down, they will still punt on the equity side. They mostly hedge their fixed income exposure and they keep the equities unhedged still. Another thing which is also kind of remarkable about this period is that in Q1, when people were projecting the rest of the year, they got extremely pessimistic. So Q2, Q3 are going to look like positive surprises. That's why I put the Citi Economic Surprises Index. You can see the values are mostly positive. I can see my cursor. In 2025, primarily because everybody's expectations were too low. And this is one of the weird things about the dollar cycle, where if you think US growth is going to improve through a mixture of rate cuts and improving expectations, you continue to pour money into the US, especially equities. All right. Final two sections. I'm going to... Ajay, are we short on time? Should we okay? All right. Excellent. All right. Here, I'm going to really focus on the inflation bit and make simple sort of linked points. The first is that the US imposing tariffs on the rest of the world is an inflation shock for its households and its firms. And depending on who you ask, it's anywhere between 1% to about 2% increase in inflation for tradables, which depending on who you ask is either a one-time increase in the price level or sort of a persistent sort of grinding increase in the price level based on how the tariffs are actually implemented. Now, this kind of hamstrings or this kind of limits the way the Fed can actually respond to any sort of real economy slowdown in the US. If you've generated some inflation by a poor policy and it's increasing your unemployment rate, you're really caught between those two dual mandates. It is pretty clear that the US is going to have higher inflation than the rest of the world. This is just a screen grab from the Bloomberg consensus forecasts. You can't see the US numbers, but I can tell you for 25, 26, and 27, that number is around 3%, about 1% above their inflation target. And for all the other large countries global investors care about, even sort of a country like India, which has a much higher inflation rate, the forecasts kind of show you that the rest of the world, non-EM at least, will have lower inflation than the US. Now, given that the rest of the world is exporting to the US primarily, their exports are hit by tariffs, the rest of the world expects a negative supply shock, a negative demand shock, but the nature of supply shock still being debated. There are a few global central banks like Reserve Bank of New Zealand, for example, who are one of the few ones who have said that it's both a negative demand shock and it's going to be a positive supply shock. given that if you have all this rerouting of exports which used to go to the US, the rest of the world, you're forcing China to export its deflation to other countries. And after an era of high inflation, that's a trade-off a lot of policymakers may make. What do you mean my population gets to have cheaper goods and I get to get off my dollar habit? That's a deal which a lot of people will consider
By
seriously.
the way, the inflation in the US, there's also this expansionary fiscal deficit effect that's going to play out over for the foreseeable future. It's not just having
Yes.
30% of GDP fiscal deficit is insane. And that's just inbuilt inflationary pressure throughout.
Yes. Yeah.
I don't get this data because for India, the year-on-year inflation.
It's a delta from the US. So the US is about 3% at the bottom, and that's the region differential with the US. This is a better chart or better sort of illustration. Fiscal policy looks more similar across the world. Everybody is running slightly higher deficits because of a trade war and smoothing sort of the negative demand shock. But in terms of inflation, there's a clear divergence of the US from the rest of the world. And there's potentially a deflationary impulse for the rest of the world, given that these goods have to move somewhere. All right. So in terms of things to really think about for the 2020s, this is split into two parts, advanced economies and EMs. The first thing I want to really talk about in terms of advanced economies is demographic forces. This is pertaining to both aging and attitudes towards immigration. There is we've witnessed sort of a huge increase in our understanding of how aging affects the economy through learning from countries which are already old, like Japan. Now, Japan is a curious case where the country has aged so quickly that they are running out of labor, even with old age labor force participation at all-time highs. And that is forcing an increase in wages, which is increasing underlying inflation. So the earlier story was that as a country ages, you get to a situation where you're stuck in this deflationary trap and you can't come out of it at all. Now we kind of know that interacts with net migration. And if you're not open to net migration, a deflationary impulse can become an inflationary impulse if you start running out of labor. This year, a lot of countries, given sort of the impulses from the post-pandemic immigration surge of 22, 23, 24, and these economies reopened, have decisively turned against immigration. The countries I'm thinking about are Canada, are like the UK, places which will see negative population growth for the first time since World War II because the attitudes towards immigration have turned. This is notwithstanding all the stuff ICE is doing in the US. This is just to give you an understanding that if you stop net migration, you're Ponziing your pension scheme, you're reducing your potential growth, and there is a really ambiguous effect on interest rates we don't completely understand yet. It is playing with fire. I'm going to skip the competition for financing of sovereign debt. The long and short of it is that everybody blew out their fist during the pandemic. They're going to blow out the fist trying to prevent citizens from facing the excesses of the trade war. We really don't know what the future of the world looks like because everybody's going to have more debt. Are we going to go into a world of financial repression and yield curve control forever? It's an open question, but it's something we should pay a lot of attention to because if financing costs get exorbitantly high when the world is slowing down in terms of growth, central banks will be forced to step in and do unconventional monetary policy even when interest rates are positive. That toes the line between a monetary intervention and a quasi-fiscal intervention. And it's a hard question a lot of policymakers will have to contend with in the future. The third thing, which is most of a mystery rather than anything else, is that if you look at indices of policy uncertainty, they are at all-time highs. They've never been higher. They jump off a chart. But in terms of investment intentions and investment, there hasn't been much of an impact. Is it because we're running wartime economies? Something has changed in our comfort or our experience of uncertainty compared to the pre-pandemic period. It's an interesting question, and its interface with industrial policy is something I think a lot of researchers are going to study over the coming years. I'm going to skip crypto nationalism for now because I don't want to talk about it. This is one of my this is the last advanced economy slide, and this is one of my favorite images. This kind of shows you global median food inflation, splitting EMs and DMs using standard Morgan Stanley classification schema. The thing that really strikes you is that for the first time since the 70s, you had a period where developed economies experienced food inflation. Everybody laughs at Indian economists when we say that we care about headline inflation because food is such a large component of our CPI basket. Who's laughing now? Without making fun of the West too much, a lot of the reason why there's such a strong rightward turn, a strong anti-immigration sentiment, is basic stuff like food prices, beer prices, bread prices. And it's something you really have to keep in mind when you think about advanced economies. Like, if you don't have resilient supply chains, or you haven't really accounted for a thing like a pandemic disrupting your food markets, you're not really doing your job right. And there's a chance that you may revert to being more of an EM if you don't really take care of these basic needs of your citizenry. All right. Final 3 slides. I'm sorry, it has been a little bit of a marathon. For EMs, I think there is a really good paper by a policy research group at the LSE called Overtaking the Masters. It's a comparison of policy communication of EM central banks with the Fed and ECB during the pandemic period. And they basically show that EM central banks have become much better at communicating their intentions of how they want to move policy. They have been very good at adding modifications that reflect their specific circumstances. And not only did they raise rates faster than DMs in the COVID inflation surge, they also managed to cut rates faster. Orthodoxy in fiscal policy as well was seen, where EMs did not blow out their fisc like developed markets when dealing with COVID. So this more of the same, please, is my message to EM central bankers. Whatever you're doing it well. As long as you can get your fisc on board, we are definitely ready for a decade of reallocation to EMs after, I guess, almost 15 years of very poor investment since 2013. All right. So I'm going to kind of skip some of the larger philosophical questions and focus on sort of an asset allocation question. A roughly 10% asset allocation out of the US to the rest of the world is about 4 trillion in capital flows to the rest of the world. So here's a simple math problem for you. India is, a 10% allocation 10% asset allocation reduction to the US is roughly 4 trillion in capital flows. India is roughly 20% equity weight in MSCI and 10% weight in GBI-EM. How much of this reallocation comes to India is sort of our challenge. Now, my India slide is kind of piecemeal. I just want to make two big points which Ajay has been making for a very long time. We face a trade-off between pivoting towards the US or pivoting towards the China BRICS pole. I believe that old ideas of balance and non-alignment are needed to protect interests and truly benefit being a connector economy. Naysayers will say we can't do it all, but I think there is a middle path that should be pursued. Old-fashioned trade liberalization, dismantling of non-tariff and tariff barriers for the rest of the world is the way to move forward if we really want to benefit, even though there may be some short-term pain. The second is a quote by US Treasury Secretary Scott Bessent, where he was asked about whether he worries about INR becoming a global reserve currency. And he said there are a lot of things I worry about. Rupee becoming a reserve currency is not one of them. It also speaks to the challenge we have in bootstrapping the INR as an international currency. We always talk about making incremental changes in our trade invoicing behavior with like-minded partners, but it is barely scratching the surface of diversifying away from the dollar. It doesn't lead to much. Building towards rupee internationalization, as a lot of people in this room have argued, is a long process. We should borrow from China wherever possible, which is, if you don't want to remove your capital controls, it's okay. I will go to your country and build you a local liquidity pool, which is dark, which is only used for trade settlement with India, but I will make sure my central bank funds it. Some kind of grandfathering of INR usage amongst our friends. But the journey only ends with us going towards a floating exchange rate and a much more open capital account. There is no question about that. I am certain at some point somebody is going to tell the FM about bootstrapping our CBDC and our stablecoin infrastructure rather than pursuing rupee internationalization. It's not either or. I think they're complementary things. But there are a lot of distractions as well on this long journey. That's all, folks. That's all I have in this long rant. I'm sorry it went a little over time. I'm happy to take your questions.